Hey, Ken Smith, welcome back. More videos today covering a broad range of subjects: financial, retirement, investing, insurance, all those types of things, long-term care insurance. Today we're going to talk specifically about retirement plans for small business owners, specifically with an eye towards trying to help the small business owner actually retire. And when we say small business owners, let's consider this 100 employees or less. And this is an actual real-world example. This is a prospect at the time who subsequently became a client of ours, and we were looking at options for him for his business. So this gives you basically the sort of the overall demographics, if you will, of he and or his employees. So he was 44 years old at the time. He was making right at $200,000 a year. He was seeing pretty rapid income increases, which we're going to continue into the near future. He had 17 total, and we're going to call these eligible employees. For purposes of that, it means full-time and at least the age of 21 years old. He had himself and one other employee considered highly compensated employees, often referred to as HCEs. So a highly compensated employee, but the IRS guidelines for 2020 is somebody who makes at least $130,000. There's also some other things that will get you classified as a highly compensated employee, including being a family member of the owner, some things like that. But for this purposes, we had one other person that qualified, making over $130,000 a year. And then we had 16 other employees who were non-highly compensated employees. Now, he had historically, by the way, his employee count had really taken off over the last 2 years. And historically, he had used a Simplified Employee Pension, also known as a SEP IRA. He's allowed to defer up to 25% of his income, with a max for this year would have been $57,000. However, you have to make proportionate matches for all your employees. So if you defer 25% of your salary for yourself, you have to make a contribution, if you will, of 25% of your employees, which obviously would get really expensive really quickly. So this is sort of this is his employee base. They range, I think we had a 21-year-old up to a 57-year-old, income ranging from the high 20s all the way up to almost $100,000 a year, other than his one highly compensated employee. And what you see here is, if we highlight it, his total plan cost would have been $264,000, which included the 50, since it's a 25% limit, he would have gotten 50 himself, and an additional $214,000 in employee cost, what he would have had to give to his employees. He would have captured less than 19% of the total contribution into his own pocket, and that just did not seem to make sense to him. So we said, okay, let's look at a 401k plan option. We did a survey of the employees, which is something we do pretty regular in plans, and we told them we're basically thinking about doing a 50 cent on the dollar match up to 6%. So if you defer 6%, we'll give you 3%. And we knew that the owner wanted to defer $19,500. So our employees answered with this. They said, okay, well, here's what I would like to defer. And our range is from 0% on the low end for the non-highly compensated employees up to 8% on the high end. And then the other highly compensated employee actually said that she would like to do the full amount. She wanted to do the $19,500, which would have been 13.4% for her. And you can see down there at the bottom, in this case, the employer would have gotten the $19,500 that he deferred, plus the $8,400 in match. He gets to do a match on his own deferral. His total plan cost, including his contribution, which we consider part of it. And by the way, on all of these, we don't take into account fees to set the plan up, management fees for the plan, accounting fees. We're just looking at the contributions to the plan, because those fees are different according to how we set this plan up. We can have the employees sharing some of those costs. So we were looking from a very high level how this plan would look for him. And so his additional cost would have been about $18,700. He would have captured roughly 60% of the total cost back to himself. And he was actually really okay with that. Although he wants it to make financial sense, he also wanted to give his employees some kind of a benefit. So he really wanted to do this as a benefit to his employees, but again, he wanted to get some benefit out of it himself. And this was a number that was acceptable to him. Our challenge is there's something called the ADP test, an actual deferral percentage test. And the way we do the actual deferral percentage test is this. We take the deferral amount total across the non-highly compensated employees. So you see those numbers right there. And we add them together. In this case, that column of numbers totals 63%. We then divide that percentage by 16, the number of non-highly compensated employees. And what we find out is, on average, those employees are going to defer 3.94% into the plan. So you see down there, we have a non-highly compensated employee average deferral percentage of 3.94, but we do the same thing on our two highly compensated employees, and we find out that their average deferral percentage is 10.2%. To pass this particular test, that spread can only be 2%. So this plan would fail the average deferral percentage test. And what happens when the plan, which some of you are probably familiar with if you've worked for plans that do this, all that additional deferral above that, so back to that slide, 5.94% would be the amount we're allowed to do, would be refunded back to the employer and to their highly compensated employees, which can create quite a mess if they've already filed their taxes. So you don't want to do that. You don't get the benefit if you fail that ADP test. You get all that additional deferral back, and you've also got to give the match back as well. So in this case, the owner would be refunded a very large part of his deferral, getting back to 5.94%. Therefore, he would get almost $9,700 right back out of the plan of the $27,000-ish that they had actually put into the plan. So about half of what they wanted to save would actually come back out to them. So what they really could have deferred is this. They could defer the $11,880, which would be 5.94%. They would get he would get a $5,900 match on that. And you see down there at the bottom, we now pass. We have a 5.94% highly compensated employee average deferral percentage, and a 3.94% as it was before. In the non-highly, his total plan cost is $36,000, roughly $500, but he only gets $17,800 of that. So he gets less than half of the total cost of the plan just from what they're deferring into the plan and what he's matching back in the form of benefit to himself. So in fact, he really gets less than 50% of the total benefit of the plan. Now, the IRS does give us two what they call safe harbor match options. So a safe harbor match option says if you'll do one of these two matches, we will waive the actual deferral percentage test. Now, by the way, there are other tests. There's top-heavy test, there's non-discrimination test. This is the test that typically is the one that catches these small employers and causes the plan to fail. When the plans get a little bit older, other tests come into play more often, but this is normally our first hurdle to see if a plan makes sense or not. Now, the two safe harbor matches are either dollar for dollar of the first 3% of deferrals and 50 cents on the dollar for the next two. Said another way, an employee who does 3% gets 3%, an employee who does 4% gets 3.5%, an employee who does 5% or more gets a 4% match from the employers. That's one option. Or, and by the way, so that only applies to those who defer into the plan. The other option is just do 3% for everybody across the plan, no matter whether they defer into the plan or not. So we run the numbers to see if either one of those makes sense for this employer. And what we see here, we lay them side by side for you. So under safe harbor option number 1 in that far right-hand column, you see the employer could do $19,500 because, again, that test has been waived. And they get a 4% match, which is that $8,000 match. So they get to defer $27,500 into the plan. Under option 2, they only get a $6,000 match because they get the 3%, because there you do the match for everybody. And you can read down the page, and actually let's go down to the summary down there at the bottom. What you see is under safe harbor option number 1, the plan's going to cost him about $53,500. He gets to defer $27,500, therefore he gets about 51% of the total plan cost from a match and from a deferral standpoint of the total plan cost. So here at the bottom of the page you see that in option 2 he gets to do the $19,500 deferral, but he only gets a $6,000 match, because remember now the match is 3% for everybody. So he gets $25,500 into his retirement plan, and the total cost to him is $51,200. So a little bit less than 50% of the cost from a match and a deferral standpoint, he gets to put into his own retirement pocket, if you will. Now, one of those looked okay, right? 51-ish%, but we wanted to make sure we ran all the traps and knew all of our options. So the next thing we looked at was a simple 401k plan. These plans are available for employers with less than 100 employees. There is no non-discrimination testing. There is no top-heavy testing. However, the deferral limits are lower for the employer. So the max deferral limit for an employer for 2020 is $13,500. And if you're age 50 or older, you get another $3,000 in the form of a catch-up. There is two set match alternatives for you. You can do dollar for dollar up to 3%, or a 2% non-elective deferral for all employees, just like what we just looked at. It's just a smaller number. So here again, we break them down. We have option 1 and option 2 in the far right-hand column. You can see the employer now gets to defer $13,500, same thing that their highly compensated employee does. Under option 1, they get a $6,000 match. Under option 2, they get a $4,000 match. We trail down to our summary at the bottom, and what we see is we're back around 50% again for the employer. Now, obviously, your census, your income, all are going to have some impact on it. So you've got to run all these traps, because nobody that's watching this is going to have this exact same fact trail as this particular individual did. And by the way, let me also just mention, I may have used these two terms interchangeably throughout. So ADP, average deferral percentage test, or actual deferral percentage test. It is actual, but in our world, they're interchangeable. If somebody says to me, we just ran the average deferral percentage test, I know that in fact they ran the actual deferral percentage test. So they're interchangeable in our world, and if somebody says one or the other to you, they both mean exactly the same thing. So again here, pretty good options, around 50%. So we really just broke them all down, put them on a single table to see which one looked best. And what you see there is that safe harbor option number 1, giving us 51.4% of what's out of the employer's pocket back into their retirement pocket, changing it from pocket to pocket. That was our best option. And this is usually where most people stop their analysis. But there's one more step that it seems to make sense to take. Now, and let me just say right here, many of our employers choose to do a retirement plan because they want to benefit their employees. But there are situations where they're looking to see, from my own standpoint, I'm not 40, I'm 56, and I really need to pile some money into a retirement plan. I need to maximize the benefit for myself. Or for whatever other reason, they have a very transient workforce and they need to make the best benefit for themselves because their workforce really doesn't stick with them. There's lots of reasons to take this next step. But the next step we take is, what is the earnings on the dollars spent? Okay, so let's look at it like this. So let's just take, for example, the Simplified Employee Pension, the SEP, across the top line. The employer's annual cost for that, now he's getting $50,000 of this, but the annual cost to him is $264,000. So over the next 21 years, he's going to put $5.5 million into the plan. At the end of that 20 years, his $50,000 at 21 for over 21 years at 6% per year. Now, you may want to argue that number. It doesn't really matter because we use the same number across the board. But you can see down in the footnotes, the historical return over the last 20 years of the S&P is a little bit less than 6 actually. So he would have $1.9 million, and that's all taxable dollars at the end of that period. So his spend at $5.5 million only nets him $2 million. That's a negative 12% rate of return. Now, if you bounce down there to the best option in this case, which goes back to the prior page, the 401k safe harbor option number 1, he would put $53,000 per year in for everybody, which means his total spend over the 21-year period is $1.1 million. And at the end of that period, he has right at $1.1 million in taxable retirement income. That gives him a negative 0.21% rate of return. Now, again, some employers are going to do this because they want to benefit their employees. But if you look at it strictly as an investment, it's not a good investment. As a matter of fact, most of our employers find that using any kind of qualified retirement plan is not the best use of money for them if they're specifically trying to save for their own personal retirement. So it works. You've got to run the traps on all of these, right? Your factorial is going to be different than the factorial we looked at here. You've got to look at every one of these options, and that's what we do. We go through the options with our clients and with our prospects to show them which is the best option for them. Now, in this case, this particular client had a pretty transient workforce, and his main concern was taking care of him and his family. So the next video in this series, we're going to look at what he decided to do, which was use an index universal life insurance policy. And then we showed him the next step in that, which is using something called premium finance, a way to supercharge his retirement with the same roughly $51,000 out-of-pocket spend that he was comfortable with here. So if you're interested in that, the next video just popped up right there. You can see the eye at the top of the screen. If your device allows that, you can click on that video and we'll walk you through how that particular strategy works. Thanks for tuning in. The next thing we're going to tackle is annuities and long-term care insurance, so stay tuned for that. And we'd love to hear from you. If you want to see some of these options for yourself, down in the description below, you can see my email address, kensmithadvisor@icloud.com, or my direct dial number's there as well, 972-816-5367. Thanks for watching.